Hello, welcome back to my channel. In part 1, we explore what SSBs, REITs, retail bonds, and unit trusts are all about. Today, let's go one step deeper. How Singaporeans actually use them, and what strategies work best, and what MAS wants you to know before investing. Many Singaporeans treat SSB as a safe box for their savings, but smart investors use it with a strategy called ladderling. That means buying SSBs across different months so you can cash out wherever you need without breaking your whole investments. Another key point, MAS updates the SSB interest rates every month, so if you see a higher rate next month, you can choose to redeem your old bond and buy the new one. It's kind of flexible, liquid, and perfect for emergency funds. But remember, SSB's rates are tied to government securities. If global interest rates fall, new SSB's issues will also pay less. Now, here's something many Singaporeans don't realize. SSBs are designed for small investors, perhaps like myself. You don't need to commit huge sums. The minimum is just $500. And you can top up in multiply of 500 up to the comfortable range that you wish as per individual. This means retirees, fresh graduates, or even parents saving for their children's education can all make use of it. Another key advantage is capital protection. Unlike traditional bonds, where prices can fluctuate if you sell early, SSB is letting you get back your full principal plus any accrued interest when you redeem. That's why MAS calls them a risk-free option backed by the Singapore government. One more unit point, step-up interest. Unlike fixed deposit where your rates stay flat, SSBs actually reward you for holding longer. For example, the first year might get around up to 3%, but by the 10th year, the average return could be higher, depending on the market environment. This encourages Singaporeans to think long-term while still keeping the option to redeem early. It's also worth noting that there are no penalties for redemption. You simply apply through your bank, internet banking, or ATM before the monthly deadline, and your money will be returned the following month. Compare that to fixed deposit, where breaking early usually means losing some or all your interest. Now, some Singaporeans use SSB strategically in retirement planning. For instance, they stagger purchase every month so that in future years, they always have one bond maturing. This creates a predictable stream of cash flow, almost like a DIY pension. It's simple, flexible, and 100% government-backed. Of course, the limitation is that SSB returns may not keep up with inflation, especially if inflation stays high and interest rates eventually drop again. That's why MAS positions SSBs as a foundational, low-risk layer in your portfolio. It's a place to park emergency savings or a portion of your retirement nest egg, not your entire investment plan. REITs. They are very popular in Singapore because they give exposure to real estate without needing millions. What's unique here? MAS requires REITs to distribute at least 90% of their taxable income back to investors. That's why many retirees love them. They are literally built for dividends. You can choose from retail REITs like CapitaLand Mall Trust, industrial REITs, or even healthcare REITs. But keep in mind, property sectors move differently. Malls may face retail downturns, while logistic REITs may grow with e-commerce. So the trick is diversification. Don't put all your eggs into one type of REITs. A balanced mix is key. For example, instead of only buying retail REITs linked to shopping malls, you might also consider healthcare REITs, industrial REITs, or data center REITs. Each sector reacts differently to the economy. Malls may suffer when retail spending is weak, but healthcare and logistics properties often remain steady. Another thing investors should know is how REITs generate their income. The rental collected from tenants, whether it's a hospital chain, a supermarket, or an office, is put together. By law, Singapore-listed REITs must distribute at least 90% of this income back to unit holders. This is why REITs are popular among retirees and those seeking passive income. You literally tapping into rental streams from major real estate assets without ever being a landlord. That said, it's important to watch interest rates and debt levels. Many REITs borrow money to acquire properties, so when borrowing costs rise, it can eat into distributions. This doesn't mean REITs are unsafe, but it does mean investors should monitor announcements from MAS and the risk managers themselves. The Monetary Authority of Singapore sets strict rules to ensure REITs don't over-leverage, keeping the system stable and transparent. And here's something interesting. REITs can actually benefit from Singapore's long-term growth story, with Singapore positioning itself as a hub for healthcare, logistics, and technology. Certain REITs in these sectors could enjoy steady demand for decades. But always remember, diversification and research matter more than chasing short-term yields. At the end of the day, REITs are the bridge between safe, fixed income, product like SSBs, and higher risk growth investment like stocks. They give you real estate exposures, regular dividends, and liquidity on the SGX all in one package. For Singaporeans who love property but don't want the hassle of mortgages, tenants, and maintenance fees, REITs are a smart way to be part of the property market. Next, let's discuss retail bonds. In Singapore, often come from big names like Temasek, Singapore Airlines, or the major banks. They offer higher interest than SSB. But here's the catch. If you sell before maturity, price can drop with market changes. That's why they better suit for investors who can hold until the end. MAS allows these bonds to be offered in smaller denominations, so everyday investors can participate. Think of them as a middle ground, safer than stocks, but not as risk-free as SSB. Another key point to note is that retail bonds usually come with a fixed maturity date, anywhere from 3 to 10 years. That means you will know upfront how long your money will be tied up and when you will get your capital back. The stability appeals to many investors who don't want the daily volatility of stocks. But unlike SSBs, once you buy a retail bond, your money isn't always as liquid. Yes, you can sell it on the Singapore exchange, but prices can fluctuate depending on demand and interest rates. If you need to cash out early, you might not always get back the exact amount you put in. Another interesting angle is who actually issues these bonds. We're not just talking about big corporations like banks and property developers. Sometimes even government-linked companies such as Temasek or statutory boards issue retail bonds because of their reputation. Many of these offerings are oversubscribed within days. That shows strong trust from everyday Singaporeans. One more thing to take note of, retail bonds are rated by credit rating agencies. A high rating means lower risk, while lower rated bonds may pay higher interest but come with greater uncertainty. This is where doing a bit of homework becomes crucial. Don't just look at the headline interest rate. Always check the issuer's finance health, past track record, and whether they have met obligations before. In short, retail bonds can be an attractive option for Singaporeans who want predictable income and a slightly higher yield than SSBs or fixed deposits. But as with any investments, understanding who you are lending to and whether you can hold till maturity makes all the difference. The next topic, unit trusts, remain popular because they are easy. Just invest through your bank or platforms like FSM1. Professionals manage the fund and you get instant diversifications. But what MAS highlight is the fees. Some unit trusts charge over 1.5% yearly. Over time, that eats into returns. So always compare. Some ETFs may offer similar exposure at lower cost. The question is, do you prefer convenience or cost efficiency? So now we all know it's not just about what these tools are, but how to use them wisely in Singapore's markets.